Hello and welcome to this session. This is Professor Farhat. In this session, we would look at the classified balance sheet, a topic that's typically covered in financial accounting, an introductory course, also covered on the CPA FAR exam section. As always, I would like to remind you to connect with me on LinkedIn if you haven't done so. YouTube is where you would need to subscribe. I have 1,600 plus accounting, auditing, finance, and tax lectures. This is a list of all the lectures that I covered, including financial accounting as well as other non-financial accounting courses. If you like my lectures, please like them. Click on the like button, share them, put them in playlist. If they're benefiting you, it means they might benefit other people, so please share the wealth. Also, please connect with me on Instagram. On my website, you will find additional resources such as PowerPoint slides, true, false, multiple choice, as well as exercises. And if you're studying for your CPA exam, 2,000 plus CPA questions. I strongly encourage you to visit my website if you are interested in passing the CPA. So let's take a look at the classified balance sheet. So what is a balance sheet? What's listed on the balance sheet are assets equal to liabilities plus equity. Now what we're going to do, we're going to take the assets and break them down into various classification, put similar assets together. Now, what is an asset? An asset, that's something that's going to benefit the business. What we're going to do, we're going to have two categories of assets. We're going to have a current asset and a non-current or a long-term asset. Now, let's talk about current asset. What is a current? Now, this group is current. Well, current items are items that are expected to come due, which is collected within and owed within the longer of 1 year or the company's operating normal cycle, company's normal operating cycle. What does that mean? Well, it's items that's either going to be collected, okay? Collected means we're gonna get it in cash, and we're gonna see a little bit further what does that mean. And owed. Owed means we have to pay it within the longer of 1 year or the company's operating cycle. Now, we know what 1 year is. So what is the company's operating cycle? Well, the company's operating cycle is usually less than a year for most companies, so we would use 1 year. But what is the company's operating cycle? We'll talk about this topic in the next chapter, but the company's operating cycle is how long does it take the company to take some cash, let's assume $10,000, invest that cash in inventory and equipment, sell the asset that they created, then collect the cash again, and hopefully they would collect, for example, 15,000. So they start with 10,000, they invest that 10,000 somewhere in inventory, they sold it, they marketed, they sold it maybe on account, they have an account receivable, then they collected the cash. How long does this process take? Let's think about, for simplicity, let's think about a retail store. Well, how long does it take a retail store to buy something, sell it, and collect the money? Usually it takes them less than a month or maybe 2 months. Think of Walmart. How long does Walmart takes to buy an item and sell the item and collect the cash? Usually it's less than a year. So most operating cycles are less than a year. Therefore, we assume that the operating cycle is 1 year. But some companies, they do have a longer operating cycle, but we will not concern ourselves with that. So our operating cycle will be 1 year. So the assets that are either collected or owed will be considered current. And we'll see a little bit more about current assets. Then we're going to have a category called non-current. So think of the assets as two big categories. A, current, two, non-current. Now under non-current, we're going to have three subcategories. We're going to have long-term investments, we're going to have plant assets, and we're going to have intangibles. So notice those three subcategories are all non-current. It means they are long-term. So we have current assets and long-term assets. So current assets, they're going to be collected, converted to cash within 1 year, and the other one will not. Under liabilities, we're going to have two categories, current liabilities and non-current liabilities. We're going to have two under liabilities. What are they? Well, current items are expected to be owed within 1 year, and non-current liabilities are expected to be owed longer than 1 year. Then we're going to have the third category, which is equity. Now we're going to go through each category separately, define it, and see what goes there. Starting with current assets. What are current assets? Well, current assets are assets are expected to be sold, collected, or used within 1 year or the company's operating cycle. What does that mean? It's some assets that's going to go away. It's either sold, we're going to sell it, we're going to collect it, it's mean collected, and obviously collected mean collected in cash, that's what we collect, or used, it's going to go away. Well, think about this. Which assets, in your opinion, they're going to be sold, collected, or used within 1 year? Think of prepaid. Prepaid are usually used up within 1 year. Think of supplies. And the easy one is cash. Cash is always collected. Cash is always cash. Think about account receivable. We collect account, when we sell on account, we expect to collect account receivable within 1 year. So those are some common current assets. Now we're going to look at other current assets and we'll explain that later. Okay, like investments, but we'll talk about that a little bit later. So those are the current assets: cash, account receivable, prepaid, and supplies. Okay. Now, what about under non-current? We have 3 subcategories. The first one is long-term investments. Now, what are long-term investments? They are investments that are expected to be held for more than 1 year or the company's operating cycle. What is an investment in the first place? An investment is when you take some money and you buy either stocks, bonds, or you buy a building, a land for the purpose of investment. What is an investment? It's basically you want to buy something now, hold it until it appreciates, goes up in value, then sell it. Or, for example, buy a building and rent that building. It's an investment. Okay. So what could be examples under investments? Well, for example, investment in stocks. What does that mean? Well, if the company has extra money, they have extra money and they don't know what to do with it. So what they would do is invest that money in stocks. Buy like AT&T, Apple computer stocks, Amazon, any stock they're interested in. Now, if they plan to hold that stock for more than a year, if they plan to keep it for more than a year, it will be long-term investment. They could also have this investment and they plan to sell it in the near future. If that's the case, the investment will be considered current, short-term. So investment in stocks, it could be short-term, it could be long-term. You could also invest not only in stocks, you could also invest in bonds. Investing in bonds, it's like borrowing money. When you borrow money, like lending money, not borrowing money. It's like lending money. When you buy a bond, it means you are lending money to the company. And when you lend money, you expect to receive interest in return and you expect to receive your money back. If you're lending money for the long term, it's a long-term investment. If you're lending money for the short term, it's a short-term investment, depending on how long you are lending the money. Same thing with notes receivable. Notes receivable is basically selling or lending money on account. Well, that could be short-term, so notes receivable could be short-term, could be long-term, depending on the terms of the note. Okay, so those are some typical account you will see under investments. The second category under non-current is plant asset. And we should be familiar with plant assets. Those are the assets that we depreciate. Plant assets are tangible. It means we can touch them, see them. They are long-lived. That's why they are in this category, because they service us longer than 1 year. Used to produce or sell product and services, like a building, equipment, and those assets are depreciated. So any asset that's depreciated is considered a plant asset. Now, land is not depreciated, and we'll talk about that later on because land have unlimited life. Although it's not depreciated, it's considered a plant asset. Now, we could have a land that's used in operation, to produce goods and services, and we can have a land as a long-term investment. What does that mean? It means we can buy a piece of land and we just hold on it until the price goes up, then we sell it. That will be considered an investment. Okay, so a land could be just land alone is a plant asset. If the land is held for speculation, if you want to sell it, then it's an investment. The third category is intangible assets, and the third category under non-current is intangible asset, and those intangible assets are also long-term assets. Obviously, that's why they are under the green boxes, because all of them are long-term. Are used to sell product and services that lack physical form. What are intangible assets? Intangible assets are stuff like franchise. Like if you want to open a McDonald's, you have to pay a fee. The fee that you paid gives you the right to operate a McDonald's. It's called an intangible asset. Copyright, trademark, like if you see Apple trademark, that's a trademark, that's an intangible asset, and many other intangible assets, which we'll talk about in a separate session. So notice the green ones are non-current assets. We have 3 categories, and this is the current asset. So we're done with the asset section, and obviously we're going to look at a balance sheet to see how it looks like. The next topic we're going to look at are current liabilities and non-current liabilities. The first thing is, what is a current liability? Current liability is a liability that is due within the longer of 1 year or the company's operating cycle. Simply put, if you're going to pay something within 1 year, it's a current liability. If you're going to keep it longer than 1 year, it's a non-current. Well, let's talk about the most common liability, which is accounts payable. How long do you think your supplier give you to pay your liability? I would say 30 days, 60 days, 90 days if they are desperate. Well, accounts payable is a current liability. Wages payable. When you owe your employees money, how long would they wait for that money? Not long, maybe 2 weeks, 10 days, a month if they are desperate and they like you, but that's about it. Okay? Let's talk about taxes payable. How long would the government wait for their money? Not less than a year, I can assure you. Okay? So those are some common current liability. Now what about notes? Notes payable, a loan. Well, notes payable, if it's short term, if you're going to pay the loan within 1 year, it's short term. What happens if the notes payable is long term? It means you have a loan for 5 years. See what's going to happen when it's long term? It's going to be broken down into 2 components. We're going to have a short-term component and a long-term component. Let me explain. Let's assume you have a loan, for the sake of illustration, for $100,000. It's a long-term loan. It's a 5-year loan. And in the next year, you have to pay 1/5 of it. You have to pay $20,000. Well, within the next year, you have to pay $20,000. And what's going to happen, you're going to have $80,000 long-term, because this is a 5-year loan. So the long-term loan, part of it will be short-term, part of it will be long-term. And we'll look at an example on the balance sheet to illustrate this concept. But the long-term loan, it could be both short-term and long-term. Now, year 5, when you get year 5, there's no more long-term, because year 5, what's left, it's going to be $20,000, and all of it will be due that year. Therefore, it will be short-term. Okay? So this is what liabilities are, current liabilities. Now we have long-term liabilities. What are they? Liabilities that are not due within 1 year. Typically what we're looking at is long-term portion of notes payable. So the loan that's due longer than a year, that's what's typically in there. As well as bonds, which is, we don't talk about bonds in this chapter, but other things, but typically borrowing on a long-term basis. That's what goes under long-term liabilities. And the last category is equity. And what goes under equity? Well, equity is the owner's claim on the assets. We have common stock and retained earning. What is common stock? It's the money that the investors invested in the company, the shareholders invested. And what is retained earning? Retained earning is the cumulative of earnings minus dividend. So it's net income minus dividend minus if you have net loss. If you have net loss in certain years, it's going to reduce it, minus net loss. So this is retained earnings. Also is listed under equity. Retained earning is the earnings of the company over the years that they kept. It's they retained earnings. Now the best way to look at a balance sheet is to actually look at a classified balance sheet rather than just talk about the classified balance sheet. And let's look at assets first. Under assets, we have current assets. Then we have the non-current. Under current assets, notice we have cash, short-term investments that we plan to sell in the near future, account receivable, merchandise inventory, and prepaid. Then we total current assets, $42,900. Notice now we have subtotal within the balance sheet. Then under non-current, we have the first category, which is called long-term investments. Under non-current, We have notes, we have investments in stocks and bonds, we have land held for future expansion. Notice this is held land for future expansion. We're not using it yet, therefore it's an investment. Then we total this category. Under plant asset, we have equipment and building minus accumulated depreciation. Then we have simply land, the land that we use in operation. Then we have total plant asset, the third category. Then intangible asset, we have 10,000. Then we add up all the assets. This will be total assets. Then under liabilities, we're going to have two categories. We're going to have category A, current liabilities, and category B, long-term liabilities. Under current liabilities, you might see accounts payable, wages payable, notes payable, taxes payable, interest payable. Most accrued liabilities are current liabilities. You might also see in this category unearned revenue. And notice what I was talking about when I talked about the loan. I said if it's a long-term loan, you may see it under two categories. So let me illustrate this. If we're talking about a loan, a long-term loan, it could be short-term and long-term. What does that mean? Well, let's look at this loan. We have a loan here, and I'm going to tell you for $175,000. This is long-term. But this loan, we have to pay $7,500. I'm sorry, it's 157, not 175. 157, 500. 157, 500. So we have a loan for 157,500. Of this loan, 7,500 is short-term, and the remaining is long-term. So notice, under current liabilities, we have a short-term portion called current portion of long-term debt, 7,500. And under long-term liabilities, we have a loan for 150,000 called long-term liability net of the current portion, net of the 7,500. So if we look at our loan balance, the loan balance is 157,500 broken down into two categories. The amount that we have to pay in the next 12 months is 7,500 of that loan, which we put under current liabilities, and the amount we're going to pay longer than 12 months, which is going to be with us for several years, we don't know, we're not told here, but it's more than a year, is 150. That's why the loan is broken down into two categories. Then we have equity, which is common stock and retained earnings. We total equity, total liabilities plus total equity gives us total liabilities and equity, which equal to total assets. So this is a classified balance sheet. Now, why do we classify the balance sheet? For what purpose? You're going to see later. We're going to run some ratios, and it will give us more information about the business. As always, I would like to remind you to like this recording. If you like it, please share it, put it in playlist. And also, I would encourage you to visit my website, subscribe if you'd like additional resources to invest in your career. Accounting is a challenging but rewarding career. Study hard, it's worth it, and good luck.